It's observed that market is more in a range than in a trend. Almost 65% of time the market is in a range. Is it really possible to make money in a range-bound market? Yes, it's possible to have option trades which work in this scenario. They are known as non-directional trades. To understand how non-directional trades work, let us begin with option chain. Take a look at this option chain of Bank Nifty. ATM strike is 39,400 and the yellow shaded ones are in the money strikes. You can see that the delta is around 0.50% for ATM strike, and it increases as we go more in the money. It means that more in the money, more correlation of option price to that of underlying. At the same time, observe the theta. Theta value is more near the ATM strike. Moving away from ATM, you can see theta value is reducing. It means being near the ATM, we can capture more of time decay. If we see the price of different call and put strikes, you can see that prices are lower and lower as we go more towards out of the money. This is the reflection of delta what we saw. If you can imagine that the values of all OTM strikes will become zero at expiry, that explains the low theta of OTM as well. From these data, we can understand that we have to be near ATM if we want to capture good amount of time decay. Also, since we talk about range-bound market, we cannot capture delta movement. Hence possibility is to short the strike near ATM. Take a look at this strategy. Both call and put at ATM strike are sold. This is called short straddle. This is one of the non-directional strategy. Since option sell is involved, the theoretical risk is unlimited. Remember, it's theory, but in reality we are talking about range-bound market. If you take a closer look, in a range around the ATM, this trade will stay profitable. This is denoted as break-even range. If you look at the Greeks of this trade, delta is zero, hence non-directional, and theta is positive. Eventually, we try to capture time decay from both the legs, provided underlying movement is less. Another important point to note is vega is negative, meaning, if IV increases, we will be in loss. Normally all non-directional trades are damaged when IV increases during the trade. Now, how to protect the risk in this trade? This can be done by adding hedge to this trade. This trade is called iron fly, which is nothing but short straddle plus long strangle. In this trade, now you can notice the max loss is contained, while clipping the max profit as well. Notice the change in values of the Greeks, theta and vega, though the sign of the value unchanged. How far the hedge legs need to be with respect to ATM? This depends on our analysis of market movement. Farther the legs, higher the max loss and in max profit. There are various non-directional option strategies. Short strangle, iron condor, ratio spread, etc. Normally, non-directional trades are credit strategies. It's important to understand the details of each strategy. Hope you liked this video. Stay tuned for more such informative videos.